Well, let's shift back to Capitol Hill now. Fed Chairman Jay Powell addressing the House Financial Services Committee. Remember, he was before the Senate yesterday. This is his second day of testimony. He's speaking on interest rate policy.
At our September and December meetings, we decided to raise the target range for the federal funds rate by 1/4 percentage point at each, putting the current range at 2.25% to 2.5%. At our December meeting, we stressed that the extent and timing of any further rate increases would depend on incoming data and the evolving outlook.
Joining us now to discuss is Albion Management Group Chief Investment Officer Jason Ware, joining us via Skype. Good to see you, Jason. So he also emphasized in his testimony yesterday that the Fed is going to continue to remain patient, right? And he talked about inflation targeting as well. That's gotten some attention. What has stood out to you from the chair's testimony so far?
Hi, good to be with you, Julie. So what stood out is that he's really just, knocking it right down the fairway as far as trying to balance the message from the Fed, a message that in some ways in 2018 was upsetting to markets, but also recognizing that the Fed needs to be nimble. They need to react to incoming economic data to be able to adjust policy accordingly. So they can't be seen as being too sympathetic to equity markets, but at the same time, increasing volatility, increasing downside because of uncertainty among the investment community on what really was kind of QT, this autopilot tightening that the Fed was underway, was unsettling markets, and that could have a ripple effect in the economy. So he's really trying to strike a balance there, and I think he's doing a fairly good job.
Is he? Because, Jason, yesterday he said in written testimony Brexit is a concern, but then when he was asked about it, he said Brexit is not a concern as it might have an impact on the United States. He was talking out of both sides of his mouth. So is he being consistent in sending a direct message to investors?
Well, I think he is on the broader message. I mean, there's certainly some finer points that I think, he could clean or tighten up. And I think we all could probably do that when we're messaging. So he's not going to get 100% of the questions correct as far as what the market wants to hear, but also being intellectually honest with how the Fed is viewing these things. But I think on balance, his broad message of we want to be patient, we are still data dependent, we're paying attention to the things that matter most, that in accordance to our dual mandate, which is, of course, employment and price stability. I think he's doing a good job there.
Hey, Jason, Scott Gamm here. I like the Yahoo Finance charts behind you, but I have to ask you, do you think Jerome Powell is finally getting used to addressing the public and the markets? Because he's been chair for a year, and the markets have dropped after every FOMC meeting except for the one we just had in January.
That's a really interesting question. I think he's getting better. I think that's the short answer. There were certainly some unforced errors out of the gate. I think he wanted to change the communication style of the Fed, early on. And there's certainly going to be some teething issues and some growing pains there. You have to learn how to speak in the way that the markets are going to, react to that aren't too aggressive, but at the same time, you want to be clear in how you see the Fed policy needing to be run and be honest with markets. So I think there's obviously going to be some false starts there and some errors, but I think he has gotten better as time has gone on, and we've seen some smoothing of market reaction to when he speaks relative to 6 and 9 months ago.
Hey, Jason, David Nelson here in New York. The Fed, and in particular Powell, seems to be punting on the balance sheet at this point. Now we're going to end up with about $3.5 trillion. Any concern out there that they're just not going to have any ammunition on the next downturn?
I think there's some concern, yes, but I don't think it's really rooted in, probabilistic thinking. So, and what I mean by that is, we're at what, 2.25% to 2.5% on Fed funds. There's a likelihood that we get close to 3 before the cycle's over, in our view, over the next couple of years. I think that's ammunition to be able to cut rates when we get into the next recession. Indeed, they're talking about managing the balance sheet now in a way that I think tries to strike a balance between not being too tight with regards to financial conditions, but again, having enough ammunition to stimulate markets if they need to. And I think one thing we all need to remember as well is that not every recession is a crisis. What we saw in 2008 and 2009 was unique. It was a 2 standard deviation event. And typically we get garden variety recessions that don't require a bunch of QE. So, can they stimulate by cutting rates, by changing their language to be even more dovish and perhaps even stimulate with a little bit of QE if they need to. I think they have the tools necessary to do that. So I'm not terribly concerned about that.
Good reminder. Thank you, Jason. Jason Ware of Albion Management. Appreciate it.
Thank you.